Statistical arbitrage, pairs trading and mean reversion. Statistical arbitrage, or stat arb, is the use of statistical models to exploit pricing inefficiencies between related securities. Unlike pure arbitrage, it's probabilistic. You're betting that relationships will revert to their historical norm. It's the foundation of many quantitative hedge fund strategies. From Renaissance to 2 Sigma, some financial relationships are mean reverting. They oscillate around a stable average rather than trending indefinitely. When two historically correlated stocks diverge significantly, there's a bet they'll converge again. You go long the underperformer and short the outperformer. If the spread reverts, both positions profit. Step 1. Find a pair with economic rationale and high historical correlation, like Visa and MasterCard, or Exxon and Chevron. Step 2. Test for co-integration. This is stronger than correlation. Co-integration means the spread between the two price series is itself stationary. Step 3. Model the spread and generate signals. Step 4. Size positions to be dollar neutral and manage risk. Correlation measures whether two assets move in the same direction at the same time. But correlations can break down, especially in crises. Co-integration is a stronger statistical property. It means the prices share a long-run equilibrium and any deviation will eventually correct. Use the augmented Dickey-Fuller test to check if your spread is co-integrated. Look for a p-value below 0.05. Once you have a co-integrated pair, calculate the spread. Price of A minus beta times price of B, where beta comes from a linear regression. Compute the z-score. Spread minus its rolling mean, divided by its rolling standard deviation. Enter long short when z-score exceeds plus or minus 2. Exit when z-score returns to plus or minus 0.5. Stop out if z-score hits plus or minus 4. Not all mean reverting spreads are tradable. If a spread takes 2 years to revert, you can't hold the position that long. The Ornstein-Uhlenbeck model estimates the half-life of mean reversion, how long it takes the spread to revert halfway to its mean. Tradable spreads typically have half-lives of 5 to 30 trading days. Shorter is better for capital efficiency. Regime change is the biggest risk. Correlations that held for years can break permanently, especially during crises. The 2008 financial crisis destroyed many stat arb books because correlations spiked and all pairs moved together. Crowding is another risk. When too many funds run the same pairs, the strategy becomes fragile. Always use rolling windows and out-of-sample testing. Modern stat arb goes far beyond two stock pairs. Basket trading uses ETFs versus their underlying components. Sector rotation arbitrage trades ETFs against fundamentally similar peers. Cross-asset stat arb finds relationships between equity, credit, and commodity markets. Machine learning is used to discover thousands of non-obvious relationships simultaneously. Well-constructed stat arb strategies are market neutral. They don't go up or down with the market. They have high Sharpe ratios because the edge is consistent. They're capacity constrained. The more capital you deploy, the more you move the prices you're trying to exploit. This is why the best stat arb funds are closed to new investors. Statistical arbitrage turns the discipline of statistics into a trading edge. It's systematic, data-driven, and conceptually elegant. The math, co-integration tests, regression, z-scores, is accessible to anyone willing to learn it. In Episode 4, we'll go from finding edges to actually building and executing algorithmic trading strategies around them.